In this generation, we owe everything to the internet. A recipe to bake cookies? The internet. The quickest route to somewhere? The internet. What stocks to invest in? Yup, you guessed it, the internet. Here are the things you need to know before investing in dividend stocks. Let's go over that right in this video. We want to dive in and discuss the 5 things you need to know before investing in dividend stocks. 1. Understand what a dividend stock is and how it works. You can't invest in something that you don't understand, right? Well, what exactly is a dividend stock? In simple words, a dividend stock is an equity stake in a firm that pays a percentage of its profits to its shareholders on a regular basis, which in turn enables its investors to accumulate long-term income through a consistent source of revenue. Any investment made which generates a dividend is referred to as a dividend stock. Dividends are then calculated as a percentage of the total amount that you will earn over the course of your investment. The dividend rate is calculated as a percentage of the stock price in dividend yields. If a company pays dividends, the sum of the dividend will be declared, and all stockholders will be paid on the following payday. Dividends may be kept as cash or reinvested in order to collect additional shares from shareholders who receive them. 2. Dividend is not a form of income or capital gain. Dividend income is quite a peculiar thing in that it is usually taxed before it is distributed to its investors. Companies pay taxes on the money that is then used to generate income, but this does not protect it from further taxation. For the company's investors, dividend investing may bring significant tax benefits. However, the Internal Revenue Service doesn't really regard all dividends equally. These dividend stocks are then divided into 2 categories, which are qualified dividends, which are those dividend stocks that are taxed at a reduced long-term capital gains tax rate, and the other one being unqualified or ordinary dividends, which are taxed as stocks as ordinary income. The majority of these corporate payouts are qualifying dividends. The revenue through dividends is taxed at the long-term capital gains tax rate if investors own the shares for 60 days. So you don't have to worry about paying taxes bigger than your earned revenue. 3. Don't be tempted by the dividend traps. To get this out of the way, we must first understand what is a dividend trap and how does it happen to companies. Many regional and worldwide investors have suffered financial losses as a result of the current financial crisis in society. Falling asset prices frequently resulted in the loss of assets, particularly those bought at the market's top. Companies typically need positive retained profits to pay dividends, and when those retained earnings were depleted by these impairments, a number of companies were compelled to halt dividend payments. When looking to invest in a dividend stock, it has been the golden rule to avoid these so-called dividend traps. A high return on dividends does not always imply that a stock is a good investment. A rise in a stock's yield is sometimes accompanied by a drop in its price, indicating that the company is at risk of decreasing its dividends or that it is unlikely to increase its payments further from current levels. Remember that with every good there is a bad part when investing in a stock. When placed under a financial crisis, numerous corporations have no other choice but to reduce or eliminate dividend payments. Even in more favorable market situations, there are more than enough warning indicators to be aware of. Dividend traps have an influence on a wide range of stakeholders. For starters, it may lead to irritation and consternation among shareholders, whether they are individuals, corporations, family companies, investment firms, or governments. Investors can finally observe positive cash and profit production after wading through the financial downturn. However, they may not have to access their own revenue. This may interfere with the shareholders' capacity to repurpose funds for other possibilities or requirements, depending on their objectives. 4. Explore the world of dividend capture. Dividend capture is a much more unmediated, active method of collecting your dividend revenue. Dividend capture eliminates the need to keep a company's stock for a complete year or quarter in order to receive a dividend. Instead, you can jump in and acquire them just as the dividend is about to be paid. Then, once you've been compensated, you sell them to make room for new investments. Pursuing such a plan, however, is far from undemanding, and it has a lot of intricacies that you must first consider. In order to get a quarterly or yearly dividend, you must possess a share before the ex-dividend date, which is usually 2 weeks before the income is generated. Dividend capture methods, in essence, are designed to benefit from the notion that equities do not necessarily price in a rational or formulaic manner around dividend days. Dividend capture, in its most basic form, is watching equities that, for whatever reason, do not move down by the predicted sum on the ex-dividend day. 5. Dividend stocks can and do get snipped. A dividend cut occurs whenever a dividend-paying corporation simultaneously stops or cuts the number of dividends it pays out. This move is frequently the first sign of a company's failing financial condition, which makes the business less appealing to its future investors or their already shareholders. It usually results in a rapid drop in the stock price. Investors should keep in mind that dividends are a result of a company's cash profits and that if the company's fortunes drop, so will the dividend. A dividend can be harmed even if there is no absolute damage. Many dependable dividend-paying banks like slashing their payments, often drastically. If you think you did all the research that you need, then go right ahead and dive into the world of stocks. Make sure to protect your money along the way. Make sure you stay connected, and we'll see you on the next one.